Good morning and welcome to this Monday, June 15th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Friday, we got a bounce back. I mean, it was kind of a good day after a rough day on Thursday, but it could have been a lot better. Friday, we opened up pretty strong, went back down, gave away all those gains. I think the Nasdaq, maybe the S&P and the Dow both, or all of them, put in new lows. And then we rallied in the final couple hours on Friday to finish with mostly positive action. But yeah, I mean, overall, after the huge beating we took on Thursday, didn't really feel that great, being quite honest. But, it was at least some repair, and we'll see what today brings, although futures are down considerably. As the market seems to be rekindling some of that fear that we saw back in March, especially early part of March through maybe the first 2-3 weeks of March, where the VIX just shot up. We went above 20 and then went all the way up near 90, up into the mid 80s, I believe, before finally beginning to settle back down. But last week we saw the VIX picking back up again. To me, that's a big warning sign. I don't like it when the VIX is high and rising. High and coming down is fine, but high and rising is never a good thing. We don't want to see fear building because that tends to lead to impulsive bouts of selling. And Thursday, I think you absolutely could consider that an impulsive bout of selling. We sold off almost all day. So we'll see what happens after the market opens today. I think we're in a period of consolidation. Who knows how far we go down? We'll take a look at some of that in just a minute. I do want to just point everyone to our website if you're unfamiliar with Earnings Beats. We do have an event coming up tonight, and it is scanning strategies. So we'll try to have on our website later for anyone coming in a link to the room. If you go to earningsbeats.com, you should be able to find a link. But for now, if you subscribe to the Earnings Beats Digest, you'll get our newsletter 3 times a week. We did have room instructions out this morning in that, but again, if you it's always a good idea just to be part of the community, because we do try to stay in touch with all of our members and give them a heads up when we're doing any of these types of events. So I think being a Earnings Beats Digest member certainly carries some benefits, and it's free. There's no cost whatsoever, no credit card. Just sign in with your name and email address, hit subscribe. If you ever want to unsubscribe, it's very simple. Hit the unsubscribe button, we'll take you off the list. But it is an educational type newsletter, gives you some trading ideas. I think is well worth the time to subscribe. Again, you can go over to earningsbeats.com and subscribe for that. Later today, like I said, we'll try to have the link up as we get closer to 4 o'clock. If you do come into the event and you're not already registered to our Earnings Beats Digest newsletter, we will register you. Again, you can unsubscribe at any time. But we really want people to be part of our community, especially with the volatile times we have and all the back and forth action. I think you'll get a lot out of it. All right, let's move on. Let's talk a little bit about today's action. We're going to go over the daily market recap. Talking technically, usually I just pull up a couple charts there. Today I just want to look at the S&P and the Dow, maybe the Nasdaq a little bit, and just look at the charts and see what the charts are telling us. Where are the key levels to watch? Now, when we get the VIX rolling to the upside and, markets kind of doing their impulsive thing to the downside, sometimes support levels aren't what they're cracked up to be. You think support level is there, but when the market gets really volatile and really fearful, sometimes you go through these support levels like they're not even there. And so price support is great when market makers are supporting the market, when they're providing the liquidity. When folks sell, you got market makers buying, then support usually holds, because market makers are the best technical traders on the planet. So they know where the support levels are. They've got their buy orders in. They support the market at key levels. But when we get fearful, there's limited capital even among market makers. They don't have all the capital in the world. And when the market gets fearful and all of a sudden volume picks up like we saw on Thursday, to me, market makers, they become matadors and they just let prices go. They're not interested in buying when the supply is so great. And so that's what you have to wait for sometimes, is capitulation. So anyway, a lot of things that we can talk about there, but we'll go over that. I'm going to show you a little bit about scanning because the event we have later today is scanning strategy. So I'm going to show you one of the scans that we run typically. Earnings spotlight. I don't know if you saw my Trading Places blog that I wrote on Saturday, but I went through the S&P 500 and just pulled up 7 stocks that I think look pretty good. Some of them are on our strong earnings chart list, some are not. But I wanted to go through and just highlight that blog and those 7 stocks with you today. And then we'll wrap up with 3 you must see. These are 3 stocks that I think left an island, a cluster island or an island cluster reversal pattern where you go up, you gap up, and then you kind of trade sideways for a few days, and then you gap back down. You leave that group of candles on an island. That can be a powerful resistance area when we try to go back higher. So I'm going to show you a few of those, and that's how we'll wrap up the show. So let's get into this. Take a look a little bit first at what happened on Friday. The Dow Jones was up 477 points. The S&P 500 up 39. The Nasdaq up 96. So on a relative basis, we definitely saw the Dow and the S&P leading. If you look at mid caps, small caps up over 2%, over 2.5%. Everything was flipped upside down. The one thing that's been constant, we have been consistently inconsistent in the market, if that's, maybe that's one way of putting it, where it seems like we are either favoring the pandemic stocks, you know, the stay-at-home stocks, the social distancing stocks, that whole theme, that paradigm that we saw develop back in March and April. Seems like the market is either supporting those stocks or they're not. Now, one thing I will say is the pandemic stocks, the stocks that benefit from all this stay-at-home stuff, these stocks have been much more consistent in terms of staying healthy technically. But there have been plenty of days and sometimes even weeks where we have seen the stocks that lagged back in March and April just completely catch fire. And I think right now what the market's wrestling with is we know things have improved over where we were a couple years ago. Economies have opened. Business is kind of getting back to usual a little bit. Not really, but a little bit. Some areas more than others. But there's a lot of uncertainty out there. And, you know, we're getting more stories of coronavirus cases ticking up in the U.S. in different states, Arizona, Texas, Florida, the Carolinas, where I am. And as a result, that's just going to create more uncertainty. We're already getting more news stories, more media talking about it. That can help to increase the volatility, which is not good for the market. And so I think we're battling right now. It seems like the market one week is saying, hey, these stocks that were hit by the coronavirus are the best stocks to be in. And then the next week or the next day or whatever, 3 hours later, it's the pandemic stocks that the market wants. And so it's almost been this schizophrenic kind of a market that we've seen over the past couple of weeks. And I don't know if that's going to change, to be honest. It's going to make for a much more challenging market environment. But I think that the uncertainty is still going to be a problem. And maybe throughout the summer as the market tries to wrestle with this. And until until we feel like it's completely under control, and that could be several months out. That could be even a year out. We could be in for bouts of volatility. I still long-term secular bull market. And I'm not changing a thing. I believe market goes higher. I think this is a brief period in our history. And when I talk about brief, I'm just talking about when you look back over 100 years, it's going to be a blip. Kind of like 1918, 1917 was back when we had the pandemic then. Back in 1987, the stock market crash. It was horrible while you were in it. But looking back, it was a blip in an otherwise bullish market. I think that's the way 2020 is going to end up going down. But it's not going to be easy navigating through it. As far as the sectors go on Friday, again, look what was leading. The areas that actually absolutely got crushed back in March, April: real estate, financials, energy, materials. The worst performer was utilities on Friday. Actually, that was the only group that fell on Friday. Everything else was up. But the leadership, you can see materials 2%, energy 2.5%, financials 3%, real estate 3.16%. Those were the areas that were strong. These were the areas that were beaten down the most when the market took the hit back in March. Probably could throw industrials in there. We don't have industrials up here, but industrials hit very hard as well. So Friday was a good day for those stocks. And if you're an Earnings Beats member or familiar with Earnings Beats, our week AD chart list, weak accumulation distribution chart list, which houses many stocks in these sectors. Those stocks did much better on Friday, but they were horrible during the rest of the week. Okay, let's keep moving on. I want to get into the 10-year Treasury yield. Just a quick note on some of the economic reports out. This morning we did have June Empire State Manufacturing give us a little look at what's going on in New York. The number was much, much better than expected. The estimate was for a minus 30 reading. We had a minus 0.2 reading, so it came in much better than expected. Market doesn't care right now. Market's fearful. We started this increase in fear last week. It's picking up again this morning. Last time I looked, I think Dow futures are down close to 600. And so I don't think it really matters, these economic reports, when you start to see the volatility pick up. And you know what's interesting is when all the economic reports were the worst, the market was bouncing the best. And now we're starting to get better than expected news, and the fear's picking up, the market's going down. So once again, to me, that's a poster child, just illustrates perfectly how the market operates. The market isn't reacting to the news you see today. The market is reacting to what it expects the news to be a few months out. And so back in March and April, when we bottomed, everyone's like, what the heck? How can it be bottoming? Look at these initial jobless claims. Look at unemployment. Look at this. Market is looking ahead. The market was seeing improvement. And that's why we saw this huge move to the upside. Now you might say, well, how can the Nasdaq break out to an all-time high? I mean, how's that even possible? Well, I'll get into that in a couple minutes, but let's focus here first on the 10-year Treasury yield, because the yield's been going down. Last week was a rough week. You see it's already down again this morning. Let me get an update here for you. Yeah, it's down right now 3 basis points, 0.67%. And what I showed you here is the 10-year Treasury yield the last year. Banks relative to the S&P 500 almost looks like a similar chart. When the yield's coming down, banks underperform. Normally, when we get a rise, the banks outperform. But that was kind of a quick, short-lived bounce, and then we continued down. You can see the banks just not performing well. We started to turn up. See the banks turn up. Then as soon as we came back down with the yield, banks on a relative basis came back down. Now, you look at this, and the correlation, pretty good, pretty solid, mostly positive between the 10-year Treasury yield and the relationship between the banks and the S&P 500. That stays mostly positive. Now I want to show you, oh shoot, I thought I had another chart. No, all right, I gotta have to come up with it. I did a chart of the spread. So let me do the 10-year minus the 2-year. And let's take a look at that. And so now what we have is the spread. So the difference between the two yields, the long-term and the shorter-term 2-year. So that's been going up. Normally that's good for banks. Look at the banks going down. So the correlation, when you look at it, I would have expected this to be mostly positive. But over the last year, it really hasn't been positive. And in fact, if we look at a longer-term weekly chart, that's where it really gets interesting, in my opinion. So let's go back, I don't know, 10 years, and we'll do a weekly. Let's take a look at what's going on here. Now, when I look at this, you can see when you just glance at it, you can see when the 10-year, when this is coming down, banks relative to the S&P 500 struggle a little bit. I mean, during this downtrend, we were moving lower. Had this little move to the upside, we rose. Little move to the upside, we rose. And then recently, check this out though, over the last 6 months, the spread has been rising, but banks versus the S&P 500 have been getting hit pretty hard. And that's resulted in inverse correlation. And if you look back over the last 10 years, this has been the worst period of correlation between the yields, what the yields are doing, the spread, and what the banks are doing relative to the S&P 500. And I'm not quite sure what to make of this. I'm watching it. I don't know if it's a situation where banks are just undervalued, because normally with the spread moving up, banks should be doing well, and they're not. Is it a sign? Are the banks giving us a warning sign about something down the road in the market? I don't know. It's kind of hard to really get a feel for what's taking place here with this inverse correlation. But I wanted to point it out. I thought it was interesting. I don't really have an answer at this point. Could be either of those two reasons, or it could be a different reason. But normally we see mostly positive correlation. And look at all the trips up here near 1, showing us really strong positive correlation. That is not the case right now. So anyway, be interested. If you have any thoughts, send it to support@earningsbeats.com. Love to hear what your thoughts are there. Okay, let's move on to talking technically. So let's take a look at the Dow here. So here's the Dow moving up, come all the way back down. We move back up, go through price. I mean, this would have been a price resistance area right through there. These prior lows would have been price resistance right through there. 20-week moving average went right through, 50-week moving average right through. And then last week we pull back, and that is a reversing candle on a weekly chart. So I'm not surprised to see follow through to open this week. I wouldn't be surprised to see us move back down and really test the mettle of the bulls as we go forward here this week. I'm very cautious in the near term. I wrote about that last week in the daily market report. Again, when you see the VIX, and I'll come back to this, but when you see the VIX, jumping like this, when we had that huge move to the downside, look what the VIX was doing. When that VIX is moving up, you want to get out of the way of the market. You don't want to try to be a hero and stay in the market, or worse yet, just keep throwing more and more money at it, because you can lose a lot of money in a quick period of time when the volatility is rising. So that makes me nervous. I would rather sit it out and let the market rebound and make me feel a little bit more comfortable that this longer term downtrend is still in play. I would rather do that than to try to be a hero and say, yes, the VIX is going to go back down and therefore I'm jumping in. It can take just 2 or 3 days of that to get you in a lot of trouble in the short term. So this is, again, more of a short-term trading problem. It's not, I don't think it's long-term. Again, the longer term, I believe we're in a secular bull market. I think prices are going to go up. But short-term, as a trader, my enemy is the VIX, because I like to trade on the long side, especially if I think we're in a secular bull market. I want to trade with the trend, the longer-term trend. It's like getting on a raft and trying to go, out on the ocean. You want to be with the current. If you're going against the current, it's a lot harder on that raft to make any headway. And same thing with the market. When you've got the secular bull market in play, I'd rather be on the long side. To me, the long side's the way to go. That's with the current. Shorting is going against the current. Might work for a couple of days, a couple of weeks maybe, but eventually that current is going to take over. And so that's why I really think you just have to be careful when this VIX picks up in a secular bull market. All right, so let's go back to that Dow chart. So this is the Dow, based on this chart, PPO, weekly PPO, still negative territory. We got work to do still. I'm not, ready to say that the Dow is just going to go straight up, even though we did see it on the Nasdaq, and I'll show you the Nasdaq in just a second. So the S&P went down. Same thing through all these different price resistance levels, through the 20, through the 50. About the only difference is we're still above the 50-week moving average. That's really the only difference here on the S&P versus the Dow. It's outperformed a little bit, and we're still above the moving averages. That may change early this week. And then finally, the Nasdaq. Notice we broke out above the February high. That's the first thing that sticks out to me. I mean, if anyone has ever seen a bear market, a secular bear market where you've got new all-time highs, I'd like you to point me in that direction, because I've never seen it before. This is one of the signs that tells me we're not in a bear market. We are in a bull market. You just don't see 52-week highs in a bear market. In fact, technically, the bear market's over when you've gone back up and broken out to a new high. That's the start of a bull market. So now the bear market was this. The bull market is this. We're in a bull market, according to the Nasdaq 100. So why, with everything going on, the virus and so much uncertainty and the economy's not sure, some opening up partially, how could we possibly be going up and setting a new high? How is that even possible? Well, I'll tell you how it's possible. Number one, many of the companies in the Nasdaq 100 are still doing a lot of business in this pandemic. A lot of these companies have adapted very well and very quickly. Some were already set up for it. With a lot of online, a lot of their business online. So that's number one. So they saw anybody who had a business set up for online saw an influx because all of a sudden business was moving off from offline to online. That's part one. Part two is these companies that are benefiting, many of which their earnings have been exploding to the upside, exploding to the upside in a very low interest rate environment. Those earnings should be valued higher than any historical period that I'm aware of because of the significant growth and because of the low interest rate environment. I don't think the Nasdaq 100 is done. I think the Nasdaq 100 is going to see continuing movement to the upside. I think it's going to completely astound a lot of folks how high we end up going. But we've got uncertainty. We got fear. We're not going to go up every day, every week. Market's going to pull back. I think this could be one of those periods. Who knows? We're going to see. But I think the Nasdaq 100, if it starts to get down close to, say, that 20-week moving average, which right now is all the way down at 8,900, I think you're going to see a lot of folks buying because these companies are worth it because of the way they're growing their earnings and in this environment. Some of the S&P Dow stocks, I think you got to be more careful with. What do you do with the airlines? When they went up 35%, not last week, but the week before, I said this is a group I still don't trust the most. I have no trust in the airlines. Last week, I think they went down 8 or 9%. They were down 20% at one point last week. With the virus, how can you possibly be feeling good about airlines? Other than to say, okay, well, they're a value play because their price is so much lower. Okay, I give you that. I'm not a value trader, so I'm not going to buy it based on that, but I give you that. From a value perspective, if everything goes back to normal next year, yeah, airlines are going to turn out to be a really good value play. I think it's a paradigm shift, though. I think a lot of folks are going to be afraid to travel for a while. And so you've got these airlines that are going to have to figure out what to do with significantly less customers. I'm not sure, how that's going to all play out, and I don't want to be a part of it, to be honest. All right, let's keep moving. Let's talk a little bit about scanning. Actually, before we talk about scanning, let's talk a little bit about one of those top news stories today. Walmart announced they were partnering with Shopify. Shopify is one of our model portfolio stocks, by the way. And they're going to expand. Walmart's looking to expand its online marketplace business. So they are partnering with Shopify. You look at Walmart here, and I'll give you the update. Walmart's up 0.5%. Shopify is the real beneficiary here, up almost 5% today, breaking out of this trading range or getting close to the upper end of this little trading range at least, moving up to about 780 this morning. I don't know, for those of you that are members, you all know, our model portfolio has just been absolutely on fire, not just this quarter or last quarter, but really since we announced the first stocks to go into our model portfolio back in November of 2018. I don't know exactly the numbers, but I do a portfolio report every weekend, and so I just did one yesterday. I don't remember exactly, but I think our model portfolio is now up about 80% in 18 months, a little over 18 months. The S&P 500 over that same period is up 13%. And if you want to get what the stocks that are in that model portfolio, you just have to be a member. You can be a trial member. So go to earningsbeats.com, sign up for a $7, fully refundable $7 30-day trial. So you sign up, you pay $7. We refund you the $7. You got 30 days to check out the service, and you can see all the stocks in our portfolios. But Shopify is one of our model portfolio stocks looking to benefit today from this announcement. All right, scanning. So here's one of the scans, and I'm going to talk a lot more about this today at 4:30. So if you're interested, make sure you come in, go to Earnings Beats. We'll have the room up. Check in after 4 o'clock, and we'll have the room set up for sure on the website. And then you can just come on in. It's free. But we will set you up in the Earnings Beats Digest newsletter if you're not already set up there. It's a free one. Anyhow, here is one of the scans I like to run. This is just simply a test. I got the scooter in here twice. Oh, well. This is simply a test of, normally this isn't here, by the way. This is a test of a stock or looking for stocks that are pulling back and testing their 20-day moving average. I'm a short-term trader on the long side. So what I like to do, some folks like to chase stocks and, when they're looking at it from a momentum perspective, they want to see stocks setting new highs and they jump on board and try to ride it. I don't do that. I like to if I catch it on a breakout, I'll do that. But if I don't catch the exact breakout, I would rather wait and let a stock pull back to key support, price support, moving average support. And that's where this 20-day moving average comes in. So I've got it, and I've run this against my chart list. So there's the strong earnings chart list. Now, if you try to put in 0300-strong earnings into your account at Stock Charts, it's not going to work because it's not going to recognize this chart list in your account. So you can't do that. And this favorites list 55, if you download strong earnings chart list into your account, Stock Charts is going to number it a different number. So this favorites list is not going to pertain to your account either. But what our members can do is basically, and what we have over at our website is we have this scan syntax. And all you do is you copy it from our website, come over here and drop it in. And then you can run scans against whatever you want. Now, what I do is what I suggest is that you go down and you grab one of the chart lists. And if you're an Earnings Beats member and also a Stock Charts Extra member or above, you can download these chart lists right into your account. And so if you do that, you can then pull up the chart list like I did here. I mean, I had there's my strong earnings chart list. Here's a short squeeze list. Here's a strong AD list. Here's a weak AD list. So we've got multiple chart lists that we can run scans against. But that's basically the scan. Now, what I did is this is the scooter over 75 because I want to just make sure relative strength is strong. But I actually stepped it up a notch and said, you know what? I want to trade the best of the best. And so technically I could get rid of that scooter, but it's all right. I mean, if it's over 95, that clearly means it's over 75 as well. So what I'm going to do is just come in here and add, and you can see right here, it's set up for 90. I just changed it to 95, hit my check syntax, make sure everything's okay. It's okay. And then I run it. And when I run this scan syntax, now what this scan is saying is that the opening price is greater than the 20-day. The low, the daily low, is below the 20-day, and then the close is above the 20-day. So if you can picture this visually, what I'm looking for is a stock that's been up above its 20-day, has been coming back down. It opens above its 20. It looks like it's breaking down below its 20 because intraday it goes below its 20 and then comes back up above its 20. And that combination sometimes can be a reversal. And so that's what I'm looking for when I run this scan. So here were the 12 stocks in this scan. And if I sort it by scooter order, I mean, if you know these stocks or if you follow a lot of stocks, you'll see these are stocks that have been doing extremely well over the longer term. And when I say longer term, I'm talking about the last 5 months. When you look at the scooter score, it really is looking at how a stock's been doing over the past 5 or 6 months. A stock could be horrible relative to where it was a year ago. But if it's been doing well the last 5 or 6 months, it's going to get a good scooter score. So that's one of the limitations of scooters. That's why I still like to visualize relative strength on a chart sometimes going back a year or more. But here you can see the scooter scores, so they're all strong. And then you can go through and you can just take a look at the charts and see if there's something you like. By the way, Shopify was on this. If you'd run this on Friday, Shopify would have been on the list. Look at the scooter, 99. And you take a look at Shopify, pull up the chart, and here's the stock's been going up, and there it is, down below the 20 on Friday and comes back up, holds the 20. Nice little hammer. And then today you get the news. So Shopify has been a great performer. And that's really, when we look at our model portfolios and really all of our portfolios, we're looking for relative strength. We want, if we're going to outperform the S&P 500, we need stocks that have been outperforming the S&P 500. Some might say, well, you know, you're chasing, you're getting in too late. Well, many of these companies have been outperforming for a long time. Apple, you know, has it been too late for the last 20 years? I mean, you just keep getting into Apple. Some of these stocks keep their relative strength for a while. We've had Chipotle, Mexican Grill, CMG in our portfolios now 4 or 5 quarters in a row because of their continuing relative strength. All right. As far as earnings spotlight, I mean, again, some of these companies were on our strong earnings list, but I just wanted to just show this article if you didn't see it. Trading Places from Saturday, or actually Sunday. This was yesterday. I put this out. I thought it was Saturday, but it was yesterday morning. Just talking about how you've got to prepare. And that's what we do, I think, at Earnings Beats better than anything else. I think we do a lot of good stuff, but I think our preparation is second to none in terms of setting up our chart lists, and then running scans against our chart list, looking at the stocks, pulling them up in candle glance, doing all these different things to get ready for a trade. I feel like a lot of folks they want to trade stocks, but they're gambling. They're just looking and they're like, oh, what's working? What's hot today? Shopify come out with a good story, so they'll jump in at the open. Well, then you get a gap fill and the stock's down $30 after you get in. And then you think, well, the market's rigged. I'm getting out. I'm taking my loss. That is not planning. That's reacting to news. That's reacting to something and then being convinced by the stock market that you need to buy the stock now. And then usually that's when it goes against you. But anyway, I went through and I looked at the candle glance on all 500 S&P 500 companies, 500 charts. I probably looked at them. I bet it was 20 minutes. I looked at all 500 charts, maybe 15 minutes. It didn't take me long. And literally I had a sheet of paper next to me. And as I was looking at the charts, I just jotted these symbols down because it was just something that was appealing to me. There were probably another 50 that could have been on this list, but for whatever reason, these appealed to me. So I went through and I showed you these charts. I mean, AMD, I think eventually we're going to get this breakout on AMD. I don't know if it's going to come this week, next month, whatever. This one, I think if I'm not looking at, my individual chart list, if I was just going through the S&P 500, this is a stock I would put on a watch list. You've got support. You could buy it at support if it gets down to 50. But I would keep a tight stop. I mean, you see it start breaking down much below 49, 48 and a half, and I'm going to be pretty nervous with this market with volatility up. So I can get in with less risk at 50. I could jump in at 54. I could have bought at 58. But if I bought at 58 and the market's fearful and we go down to 50, I'm going to be down $8 by the time I hit support. It's going to start becoming an emotional trade for me at that point. So I would rather wait and identify these stocks, have them annotated, looking at the key levels. And you could even take it another step further and use the alerts at stock charts and set up alerts so that stock charts will tell you when your stocks are hitting a certain level. So AMD, you could say, hey, I want to know when AMD is getting to 51. I just want to be alerted as it's getting close to this support level. So you could have it just above the level you're watching. So at least it's getting close. So many tools at stock charts. And I'm not going to go through all these charts. I know we're already over the 30 minutes, but here you can see Conagra. Next one's Clorox. All of these very similar in that they're consolidating sideways. F5, love this report that they had, but they're consolidating. This isn't bad because it hasn't been going up with the overall market for the last 6 weeks. Look at the relative strength versus the S&P and versus its telecommunications equipment peers. You might look at that and say, well, it's got horrible relative strength. I don't want to be in this. Well, but look at the relative strength before. It was going straight up like a rocket. So we're getting sideways consolidation. When you consolidate, you're probably going to underperform. It's okay. Now, if we broke down below this gap support level and below the moving averages and the relative strength is falling apart, yeah, I'd be out. But as long as we're just consolidating, I actually think this is bullish to allow that relative strength to come back down a little bit. All right, next up, Fortinet, FTNT, another one moving up, sideways consolidating. Eli Lilly, this one's interesting because the healthcare group's been so weak. If there's been one surprise to me in the market for the last 2 months, it's how weak the healthcare stocks have gotten. I'm starting to get a little bit concerned about them. I'd really like to see, we had a big reversal on Friday in the XLV holding support. I'd really like to see that hold, but Lilly is down here, and I think eventually it's going to break out of this channel or maybe even a little bit of a bull flag that it's been in. I think we're going to have a run into earnings, but if it breaks down below 142, 141, I'd have to be a little careful here. And I think the last one's Vertex, biotech, one of the strongest biotechs, been consolidating also in that healthcare space. So you can see on a relative basis, they've been struggling. But again, that to me sets up opportunities, especially as they get close to support. All right, last thing, 3 you must see. Just want to go over these quickly. 3 Dow stocks. We've got Boeing. Look at these on an island. See how we gap up here? Gap up, continue moving up, come back down, and these 4 candles are on an island where we have a gap to get to it. Just think about this being water, on a map. And all of this right here is just out, got a little island sitting out in the middle of the water. And then we gap back. We head back to the shore on the other side. And so we'll have to see what happens. But getting back through 200 or a little over 200 on Boeing is going to be really difficult. We'll get an update, go through and show you the current chart. Yeah, it's back down to day 11. But I think, watch that 20-day moving average. If that fails to hold, I think you got to be really careful with Boeing here. Dow is the second of the three you must see. All right, not sure why it did that to me. Let's try this again. No, I'm not getting anything right now. All right, there we go. All right, so Dow is gapping back down below the 20-day. Going to want to be careful on this one. But again, look at those 4 candles up there on an island. Now, does it mean it's a long-term top? No, it doesn't mean it's a long-term top. But look recently. You see here? See how we got this gap up? 3 stocks, 3. This is an island cluster reversal. We gap back down. We go down for another 4 days. Look up here, these 2. Little island cluster reversal. We go back down. Eventually, both of these we came back up. But short-term is what the problem is. And so are we going to go back down maybe into this 35, 37.5 area, somewhere in here? Possible. In fact, that's probably what I'd be looking for. Last up is Delta Airlines. Everything's just a little slow. I don't know if it's my internet or maybe it's stock charts right now. But anyway, here's another one. You had these 3 up on an island, gap back down. Here was your gap up, gap back down to come off that island, continuing to move lower. So the airlines, Delta, you can see down 6.5%. Quick update on the market, then we'll wrap this thing up. Got the Dow right now down 645. The S&P down 62. The Nasdaq performing a little bit better on a relative basis, but still down 139. You can see the Nasdaq 100, best of all the major indices, down 126 points, just 1.3%. Look at the VIX back up over 40. When the VIX is 30s and 40s and rising, we got to be careful. One thing to watch for now is to see on, when I look at the Dow Jones, actually, we already took out the lows from last week. I was going to see if we could hold those lows, but we are back down below. And on a 5-day chart, you can see, here was the low. Now, if we go down and quickly recover and then start, and have a trend day the rest of the day, the upside, that'd be bullish. I'm not holding my breath for that one just yet. But, volatility index up in the 40s. We got to be really careful here. That's kind of the theme, I would say, at this point. All right, everybody have a great day. Remember, we got an event coming up after the close today, 4:30 p.m. If you're a member, we'll send you instructions. If you're not a member, make sure you come into our website, earningsbeats.com, after 4 o'clock today, and we should have room instructions where you can join us. Everybody have a great day. Happy trading.